is our moment, the big moment of the Global Leadership Summit when we want to honor our icons. This is the citation. Dr. C Rangarajan shepherded the Indian banking system and the economy for a decade and a half, first as Deputy Governor of Reserve Bank of India from 1982 to 1992, and then as Governor from 92 to 97. As Governor, Dr. Rangarajan, along with his Finance Minister, Dr. Manmohan Singh, planned and executed a bold liberalization of the financial sector. Under his watch, lending and deposit rates, which until then were set administratively, were freed and set by the banks themselves. The dollar-rupee exchange rate, which was also administratively set, became market-determined. As banking regulator, Governor Rangarajan brought Indian banks to global standards of income and NPA recognition by implementing the Narasimham Committee recommendations. He also ensured a quantum leap in the Indian banking system by giving banking licenses to private entities. And we now have a host of excellent private banks. Dr. Rangarajan is an inflation warrior, and he nearly stamped out double-digit inflation from India in the 90s. For his outstanding contribution to the economy, he was awarded the Padma Vibhushan in 2002. Post-governorship, Dr. Rangarajan continued. Post-governorship, he continued to serve the country as the chairman of the 12th Finance Commission. For his intrepid and intelligent leadership of the Indian economy and the financial sector, CNBC-TV18 is honored to award him the title of Icon of the Indian economy. May I request Shireen Bhan to join the governor in presenting the citation and the memento to Dr. Rangarajan. Can we have the citation, please?
Ladies and gentlemen, if we can give Dr. Rangarajan a standing ovation for his contribution to the cause of the Indian economy.
Dr. Rangarajan literally built the economy as we see it today. It was a very different socialist economy before his time. Dr. Rangarajan, may I please request you to address us?
Governor Das and friends, I am deeply grateful to you for the award that you have conferred on me this morning. It's a matter of great personal satisfaction, as it is a recognition of one's work. I was in the first year of the college when India gained independence. Thus, I have seen independent India function through my entire adult life. I have seen India's successes and failures, aspirations and disappointments, crises and their resolutions. After a long stint in the academia in India and abroad, I left the academia in 1982 when I joined the RBI as a deputy governor. And since then, I have been involved in public policy in one way or another. India faced an acute economic crisis in 1990-91, triggered by a severe balance of payments problem. What was significant was the way in which we dealt with the crisis. We did not just find a solution to the balance of payments problem, but effected a fundamental change in the Indian economy with a view to ensure that such a crisis does not arise again. Thus, it was a paradigm shift that we effected in 1991 and later on, of course. We made a break with the past in three important ways. First, we dismantled the large network of controls, licenses, and permits which dominated the Indian economy. Barriers to entry and growth were slowly relaxed and finally removed. Second, we redefined the role and the definition of the state in administration, in the management of the economy. While we fostered the expansion of the government in certain areas like social infrastructure, we contracted the role of the state in areas where we thought markets can function effectively or made to function effectively. Therefore, the third one was actually a very important one, and that is to give up the import substitution strategy of development. We decided to embrace the worldwide trade and be a competitor in the world system and be efficient in order to be able to compete in the world economy. In the case of the financial system, with respect to the financial system, as Lata mentioned a few things, the one important thing that we did, which is very critical for Reserve Bank of India, was also to eliminate the automatic monetization of the fiscal deficit. Many people will be surprised to know that we had a system operating at a time because of an agreement between RBI and the government, that whenever the cash balance of the government fell below a particular level, it was automatically raised to another level, to the required level, by the issue of ad hoc treasury bills. This essentially meant monetization of the fiscal deficit. We put an end to it. And we also did one thing, that is, we dismantled the administered structure of interest rate. Even government had to go to the market to raise funds in the market-determined rate. That is very important. We talk today about the financial system, developments in various areas, what happens in the money market and so on. All that is possible only because we put an end to the way in which the government was raising interest rate earlier. So in the field of the foreign exchange market also, it was already mentioned that did away with Reserve Bank of India determining the exchange rate every morning. I must tell you, I did this job for 10 years as Deputy Governor every morning. I had a special phone at that time because people should not be interrupting me at that time and got calling me at that time and used up the phone. And that is what we did I did in 10 years. But I must also say that we were conscious of the fact that we need to do something which is what the market should be doing, and that is why I used to use the expression, we used to mimic the market when we were determining the exchange rate. But as Mr. Das was mentioning a little while ago, we made it clear at that time, while the market will determine the rates in the foreign exchange market, it does not mean that the RBI will not intervene. The whole question was only for what purpose the RBI will intervene, and we made it clear, and I think that has been practiced so well and so eloquently in the recent period of saying that it is really to maintain stability and reduce volatility in the foreign exchange market. We must also note that the rupee was made convertible on the current account during that period, and subsequently other measures were taken. And we made the banking system, or we tried to make the banking system more competitive. First of all, in the case of the public sector banks, we reduced the share of the government in these banks. Please remember, this is not such an easy thing. It may look like saying that from 100% you go down to 49%, 51%. It's not easy, because there is a strong attachment among the politicians to the nationalization of the banks, and therefore not easy to get through it. But we did that. So in a sense, the prudential norms were introduced and all that. I want to mention one thing, that we anticipated liberalization. And in 1985, Governor Malhotra and I gave the freedom to the commercial banks to determine or fix the interest rate for deposits or for funds for less than 1 year. This could have been the beginning, but it was aborted. I must say, partly because of the lukewarm support of the government and the very inept way in which the commercial banks also acted. What they did was they made 8%, which was the ceiling that was put on all deposits from 15 days to everything, because some banks, which are not really very important, did that. But anyway, I say that we anticipated it and did this thing. Let me come to one point. The results of these actions are clearly seen. The growth rate since the liberalization movement and the continuation of the liberation movement. I do not say that everything did only in the first 5 years or 10 years. It has continued. And the growth rate has improved. And the poverty ratio has also come down. I think very substantially the poverty ratio has come down. Today, we are able to think in terms of India becoming a developed country in 2047. Well, it's not going to be that easy. The journey is not going to be that easy. But we are talking about it because of the improvements that have already happened. It means, what is a developed country? A developed country is one which has a per capita income of $14,000. By 2047, the norm itself will become higher. 14,000 will not remain 14,000. But all calculations indicate that the required rate of growth in order to achieve that will be about 7% or more, depending upon what happens to the exchange rate and other things. But any improvement in the exchange rate, any improvement in the process is going to be tough for any growth rate higher than 6%. Up to 6% we can manage, but as I said, calculations indicate that it will be greater than 6%. And therefore, we need to have a strategy of development. Perhaps the seminars like this or the summits like this I will provide that. But I don't know. I was asked to speak only 5 minutes or 8 minutes. Many questions were raised in the morning. I am sorry I cannot answer them. But I must say, there are theoretical issues that have come up. Mr. Piyush Goyal, Minister, has said about stimulating demand. Yes, stimulating demand is important. But at the same time, please remember, in the 1950s, Arthur Lewis said, the core of development is how a nation which is saving 5% of the GDP saves 10% of the GDP or more, 50. Therefore, those who believe in the Herrera-Domar growth model, which says the trigger of growth is investment. Now, if investment has to increase, now it has to be financed, and therefore savings have to increase. Now, in the discussion on the performance of the economy, many people start talking about the demand is not increased. Now, when we say that consumption is not increasing, you are caught in a dilemma. On the one hand, we are saying that investment must increase. Then the investment increase must be supported by higher savings. But on the other hand, if you say that it is consumption increase is not there, and that is why the economy is not picking up, it raises a big fundamental issue regarding at what point in the development of the economy the demand factor begins to dominate over the other factor. I think not much discussion has happened on this, and I think we really need to analyze this particular problem. But I don't have that more time, and I will leave it here. But I would finally say, nonetheless, growth by itself is not adequate. I think the benefits of growth must reach out to all segments of the society. Growth and equity must be the two legs on which a nation must walk. If we ignore any one leg, then the nation or the country can only limp along. Growth and equity should not be posed as opposing considerations, but must weave together to produce an acceptable pattern of development. Therein comes economic wisdom or economic statesmanship. I would like to thank Mr. Das, Governor Das, being here and giving the award. He has done an exemplary job as the Governor of the Reserve Bank. And he has managed through a turbulent time, which demanded at one time an expansion, at another time a contraction. And the excellence in monetary policy lies not only in saying what is needed to be done, but also in timing. That is critical. When to expand, when to contract, and when to identify. And therefore, I am very happy that the award has been given to me by him. And I also want to congratulate CNBC-TV18 for the very fine work that they have done. As a channel, they have gained reputation for a clear presentation and a depth of analysis. And therefore, I congratulate them, and I am sure they will continue to be in the forefront as they move from the celebration of Silver Jubilee towards the Golden Jubilee. Thank you very much.
Thank you, sir, and thank you, Governor Das, for being with us.